Many traders have one question: the candle has not reached my price yet, so why did my order get filled? The price was still a bit away from my stop loss. So why was my stop loss triggered? The problem may not be the candle. The problem is, you do not really understand bid and ask. On a trading screen, there is never only one price. There are two prices: ask price and bid price. If you open a buy trade, you usually enter at ask. If you close a buy trade, you usually exit at bid. If you open a sell trade, you usually enter at bid. If you close a sell trade, you usually exit at ask. The gap between bid and ask is called the spread. So spread is not just a small number. It affects where you enter. It also affects where you exit. For example, you want to buy. You see the candle price has just reached your entry level, but your real entry uses the ask price. If the spread is wide, your actual entry price may already be higher than the price you were watching. The same thing happens when you set a stop loss. If you are holding a buy trade, many stop losses are triggered by bid. You may think the candle has not touched your stop loss yet, but if bid has touched it, your position may already be closed. For sell trades, it is also the same logic. You may think price has not reached that level yet, but once ask triggers it, your stop loss may be executed first. That is why many beginners feel, is the platform hunting my stop? But many times, the real issue is this: you only watched the candle. You did not watch bid and ask. Now let's talk about spreads. On different platforms, not every platform has the same spread. Some platforms use floating spread. When the market is stable, the spread may look very low, but during data releases, market open and close, major news, or low liquidity, the spread can suddenly widen. Some platforms show lower spread, but they charge a fixed handling fee. Some platforms do not charge extra handling fee, but their spread itself may be wider. So do not only look at the low spread shown in advertisements. You must look at the real spread during live trading. Is it stable or not? Especially for gold, oil, and indices. When volatility becomes strong, the spread can change more obviously. For short-term trading, what is the biggest problem? It is not only that your direction is slightly wrong. It is that when you enter, spread already takes one part. When you exit, spread takes another part. One entry, one exit. Before you really make money from the market move, your cost is already there. If you trade frequently, spread and handling fee will keep pushing your break-even price further. So short-term trading is not only about win rate. You must calculate this. How many points must this trade move first before I truly start making money? Now, let's talk about slippage. Slippage and spread are not the same thing. Spread is the gap between bid and ask. Slippage is different. It happens between the moment you click the order and the moment your order is actually filled. During fast market movement, you click one price, but the final filled price may become another price. In a normal market, slippage can be good or bad. Sometimes your entry is better. Sometimes your entry is worse. But if one platform keeps giving you the same problem, you must pay attention. Your entries are always slightly worse. Your exits are always slightly slower. Your stop losses always get hit very precisely. And when you are in profit, closing the trade often gets stuck. Then you should start checking the execution quality. There is another situation called order lag. You want to enter, but the order keeps loading. You want to close, but the button does not respond. You want to exit by stop loss, but the system delays. When the order finally gets filled, the price is already different from the price you saw. In this situation, what you lose is not only spread, you also lose money from execution delay, slippage, and platform execution quality. So when you judge a platform, Do not only ask, is the spread low? You must check for things. First, is the spread stable during normal market conditions? Second, during data releases, does the spread widen too much? Third, are opening and closing orders smooth? Fourth, is the slippage reasonable, or is it always against you? Remember this, what you really trade is not one single price. On the candle chart, you are trading bid, ask, spread, slippage, and execution speed. Before opening a trade, check bid and ask first. After entry, check your filled price after the trade is closed. How far was your entry price from the price you saw? How far was your exit price from the price you wanted? Was your stop loss triggered by bid or by ask? If you do not check these things, you may think you lost to the market, but actually, from the moment you entered, your real trading cost may already have been calculated wrong. Follow me. Next episode, we talk about how to check your trade record to see whether slippage and filled price are normal.